investment book of record, or IBOR for short, is actually a very simple concept. It is giving you the ability to see your portfolio from any type of assumption you want, depending on who you are, what role you have, or what the use case for the portfolio is. Now, the term itself has become a bit unclear what it means, and that is because vendors that don't have an IBOR claim to have one. The definition of an IBOR is actually very clear. It was defined in 2014, but vendors that don't adhere to that standard still claim to be one. So in this video, I'm going to walk you through what an IBOR is, the 3 generations of IBORs, and there really is only one, which is the 3rd generation, that is the true IBOR. But since the terminology is being used a lot, then it's probably easier nowadays to think about IBORs as 3 generations and then instead bucket the IBOR. Think about everything as an IBOR and bucket them into one of those 3 generations. And I'll walk you through all of those 3 generations and how to easily spot which one you are potentially evaluating. And then we'll get into the use cases of the Generation 3 IBOR, how it works, how it's meant to work. I'm going to cover what are other types of books of records, accounting book of record, custody, performance, ABOR, CBOR, etc. What they are, how they relate to the IBOR. And then finally, we are going to look at how an IBOR might fit into your operating model. So is it part of a system? Is it part of multiple systems? It's a standalone system? Can it be either of those? And what are the implications for you as an investment manager? So let's get into it. IBOR Generation 1, or flush and fill system, is essentially a system that takes a position or cash view from an accounting system or fund admin. It reads it into the 1st generation IBOR, flush and fill IBOR system, and that happens start of day. So start of day positions go into the 1st generation IBOR, and then every night it's thrown away, flushed, and then filled again, which is why it's called the flush and fill system. And then this intraday view is adjusted. So various adjustments are applied for orders, sometimes for subscriptions, for corporate actions, etc. And then some of those adjustments are actually still relevant the next day. So good to cancel order, for example, that's not filled, a future corporate action, etc. So when the new view comes in, it needs to be readjusted for all of those things. In the 1st generation IBOR, it was created because in theory, it is easier to maintain. Just take the view, basically, you apply some adjustments, and that is it. However, it's actually not easier to maintain because it's really complicated to understand which adjustments are applied, should be applied, and what you get from the accounting system. So settlement failure, has that been included, or well, probably not included, right, in that case, but there's no adjustment for it. So can we trust cash? No, we can't. We just can't, it's fact. So that has all sorts of implications on cash buffers, which hurts performance, etc. And the 1st generation IBOR, or flush and fill IBOR, it's not an IBOR actually. It's not a book of record because it can't be used. You can't, as a book of record, you can't use it for downstream things like performance calculations or reporting because you throw it away every night. And it also can't function as a duality check because you're taking data from a fund admin or an accounting system, reading it into the IBOR, and then do you want to reconcile that data back? But it already came from that source, so it can't be used for duality, essentially. So there's very little value in this model, and it has a lot of complications, and it's actually not even easier to maintain than to maintain a standalone proper book of record. So there's no reason anymore to run such a system, and it's not an IBOR at all. We cover it here because some vendors that are flush and fill systems, they will claim to be an IBOR. So if they do, it's probably just easier to think about these 3 buckets and then categorize them as, okay, they're generation 1, instead of trying to figure out who is an IBOR, who isn't, etc. But since these limitations were there, a 2nd generation of IBORs came along. The 2nd generation IBOR is actually quite similar to the first one, with the biggest difference in that it builds up the positions and cash from transactions itself. And it does so by using yesterday's view of the portfolio, applies everything that has happened since, and creates a new view today, which is then the current view of portfolios. So it's now independent of an accounting system or fund admin, which is the biggest benefit of the IBOR Generation 2 compared to IBOR Generation 1. In fact, often an IBOR Generation 2 can be an accounting system. And to that end, it is usually complete. What I usually call it eventually complete. So a accounting system can't be missing things. It must have all of the information, so it must be complete. But it is in no rush to be complete. It needs to be complete by the time that we close a period. So that's why I call it eventually complete. It's usually not complete intraday real time. It's fine if some posts arrive a day or a week later even sometimes. Just needs to get there eventually. The benefit with the Generation 2 IBOR is that not only can it serve as a standalone system, but it can then also be used for reporting, performance calculations, etc. Now, it still has significant drawbacks. The main one stems from the fact that it holds one time series, usually the accounting time series. So there's one position time series, which is the NAV time series or the accounting time series of each portfolio. That means that anything that the front office sees, for example, intraday, is just adjustments again. And you have that same problem with the adjustments. And some Generation 2 IBORs, they do adjustments better than others. They might still struggle with sort of rolling up future exposures, not only cash into the future, the cash ladder, but exposures into the future, which might be a problem if you have a discrepancy in settlement days of changes that you're making to the portfolios. Some buy, some sells, and different ones, which can be the case just in liquid markets and public markets, but also when investing in fund of funds. And if you're an LP, you might even have deal dates that you're working towards far into the future. And then being able to simulate a redemption in one fund to finance something else that you haven't committed to, but you put a trade into the future, etc. These sort of things becomes very challenging for a second generation IBOR. And also adjusting for just cash of simulated trades, even in public markets, can be a severe limitation, which is why the third generation IBOR was born. So the third generation IBOR is very different from the first two. It doesn't store positions or cash at all. It builds the portfolio up on the fly, which is why it's also called a live extract IBOR. It extracts the positions and cash live from the historical record of transactions that happen. And this means it's incredibly powerful. It can create any view of portfolios instantly that you might require. Instantly meaning within milliseconds. So there shouldn't be any delay of waiting for a process. It doesn't matter how many transactions there are. Shouldn't be delayed, then it's not usable anymore. So that needs to be a requirement. And the views that it can create is, for example, well, it can create the accounting view, the NAV view. So you request everything that has been that goes into that view. You got it. Do you want the settled cash to reconcile against custodian? Ask for that. A couple of milliseconds later, you have it. You can run that reconciliation. Do you want to see simulated things and preliminary deposits in the front office? Request it, and you've got it. The most common concern about an IBOR Generation 3 is the data maintenance. So the common question is, doesn't it require more maintenance than, for example, the second generation investment book of record? And it actually doesn't. They both need to be complete, right? So both needs to have all information. The Generation 2 is not in a rush to get there. The Generation 3 would like all information, all data possible as soon as it's available. That's usually quite straightforward to solve. When the information is available, it might not be known to what certainty something happens. But the IBOR Generation 3 solves that by having the state concept about how certain is something. So you enter preliminary subscription and it's marked as preliminary. And then when you extract the view, you just select, do you want preliminary or confirmed cash? And then it's in there or it's not in there, depending on what you've selected. So it's actually not more maintenance with the Generation 3 IBOR than a Generation 2 IBOR or not even a Generation 1 IBOR for that matter. The maintenance is the same in the end, but the value that you get from Generation 3 IBOR is just incredibly vast. Limina is one of, to our knowledge, 2 vendors that provide a Generation 3 IBOR, and if you want to learn more about the capabilities of our IBOR, you can follow the link here and learn more. The way the 3rd generation IBOR works is that it has 2 concepts. One is time, and one is state. So time, you tell the IBOR, the Generation 3 IBOR, which point in time do you want the portfolio at. If you request a range, a time series, it's going to do a request for each time in that time series. So let's just use one of the dates as an example because it's easier when walking through it. So you select the time, and then you select the state. State meaning transactions at what certainty level should be included or not. And the IBOR then goes out and it fetches all transactions since beginning of time with that certainty level or state that you provided until the time you provided. And it then calculates the positions and cash per that date from all of the history. That's as simple as that. Now, there are a couple of things to mention around the state specifically. So first, explaining what are states. The easiest way to think about it, at least in my view, is that if you start from simulated, that includes everything. So anything that the portfolio managers have simulated and what happens since in market things and settle, etc. And then as you go down, you sort of remove information. So if you go to pre-trade, then you exclude what is just simulations that the front office are playing around with. And then you go one step down and you exclude the things that haven't been routed to market. So now this is working, so orders that have actually been committed to. And then you go down and sort of just look at what has been executed. So for a listed equity, for example, if it's filled to 20%, it's going to then just include those 20% and ignore the other 80 because they are still working, and so on. So the state is sort of a everything included and then removing things. And the second thing to understand about states is that there are 2 ways to model states between investments and cash. So the original definition of investment book of record, or IBOR Generation 3, that was published in 2014, it uses one state for both of them, which means you can't combine a preliminary cash, like a subscription, with a state further along on the investment side. And at Limina, we think that you should be able to, because we are coming across some use cases where that is relevant to do. So in Limina specifically, you have 2 states, one for cash and one for the investments, and you can combine them. So in Limina, you choose 2 states and the date, and that's the input you give to the IBOR to then get the portfolio view that you want. And last thing to mention is that this isn't a batch process, at least not in Limina. So you don't request the view, you get it, and then you have to re-request it and get a new one. You can subscribe to it. So you take all those 3 settings and you subscribe to that view. So you can subscribe to the real-time view. So time is then now, depending, and 5 seconds later, it's still now. It's not 5 seconds ago. And the states as well. So any transactions that come in, recalculates the view, and you get a new view immediately. So it's useful for intraday monitoring, and it's not a batch base where you have to refresh and get a new one when you need it. The definition of investment book of record Generation 3 is actually very clear. It wasn't even defined as Generation 3, it was defined as the IBOR standard in 2014 by a consortium of asset managers. Now what happened was that technology was incredibly expensive and difficult to build, especially for vendors that already had a Generation 1 or 2 to build the 3rd Generation 1. So instead of embarking on a huge R&D project, those vendors embarked on a marketing project to convince the industry that what they had was an investment book of record. And this is why the term IBOR is now it's not unclear, it's actually clear, but it's used for things that it's not defined to be. And this is also why we believe now it's easier to call everything an IBOR and then divide them into these 3 generations, because that's how people actually use it in the industry. So IBOR in daily usage within this industry actually just means a position and cash view. So if you look at those 3 generations of IBOR, so the first one, the flush and fill IBOR, or flushed and filled position and cash view. And the second one, the rolling balance IBOR, or rolling balance position and cash view. And then the third one, a live extract IBOR, or live extract position and cash view. All of these are position and cash views. They just go about position and cash views differently. And that's probably a more pragmatic way of approaching the definition, even though as it should be, or it is defined, the third generation is the only true IBOR. So now that you understand what an IBOR is, how does that relate to the other books of records? The accounting book of record, ABOR, the custody, CBOR, performance, PBOR. Starting with accounting book of record. So accounting book of record usually means where does the accounting statements or the NAV time series live. That could be within the same system as where the IBOR lives, because the IBOR can actually service as the ABOR. So if you remember the second generation of IBOR that we covered, it's the rolling balance, usually the NAV time series. So, and the IBOR can just create those on the fly with the right settings on states. So the IBOR can replace the ABOR, but not vice versa. The ABOR can also be external. It can live in a separate accounting system from the IBOR, or it can even live with a service provider like a fund admin, in which case the IBOR is reconciled against the ABOR. The CBOR, custody book of record, usually lives within at custody. So the IBOR creates the custody view and is reconciled against the CBOR, but the CBOR technically is separated and lives at the custody. The IBOR Generation 3 makes it easier to reconcile your data against the custody. And the performance book of record is what's used for performance calculations. The IBOR can replace the performance book of record, but if you don't have Generation 3 IBOR, usually the PBOR performance book of record needs to be a separate system. Let's look at how the IBOR relates to the operating model you have as an investment manager. The operating model for an investment manager basically just means how does your system landscape look for the investment management workflows. To the left here, we have what is called an all-in-one system, or a front-to-back system. We have one system that covers most or all of the functional capabilities you need in the front, middle, and back office. And then to the right, we have the opposite, which is a best-of-breed system, which means that you have one system for each functional capability, and then you have to integrate them with each other. And it's a grayscale, so you have potential operating models in between. The challenge with the best-of-breed model is that most of these systems require a book of record. It could be generation 1, 2, or 3. Most of them requires 1. And the challenge with the front-to-back model is that the front-to-back system will require a book of record as well. And now it's very important which type of book of record that is. It really needs to be at least the second generation, because the third generation, you don't have the duality checks. You can't use it to reconcile. You can't operate your system without that start of date position working. So you're taking extreme operational risk if that were to be a generation 1 IBOR, and it doesn't even really work. It can't function as an accounting view, for example. So it needs to be at least generation 2, but ideally it should be generation 3. The challenge with that is that, to our knowledge, when this video is being recorded, there is actually only one provider that is a front-to-back solution built on a generation 3 IBOR, which is Limina. And if you want to check out more about what we do, you can follow the link here to our website. You can learn more about the product, the capabilities, and the types of investment managers that we service. My name is Christopher. I'm the CEO of Limina. I publish content regularly to help investment managers around their operating model, technology, evaluating vendors, etc. I do that on my LinkedIn, which you can find here. Please feel free to connect with me there.